Hi, good afternoon, everyone. A warm welcome to InCorp's TCFD and Climate Disclosures Reporting webinar today. I'm Benny, your host and MC for today's webinar. Before we introduce our webinar speakers, I would like to highlight a few points and do a quick introduction to our company, InCorp Global. We are the leading one-stop corporate solutions provider and business advisory group in the Asia-Pacific region for corporate incorporation, corporate secretarial, taxation, accounting, compliance, and risk assurance services. Visit our website www.incorp.asia for more information. After this presentation, we will have a 10 minutes question and answer session where guest participants can ask our speakers your questions. Additionally, we will also record this webinar session and share the recording plus the summary key points with all the participants in due course. I'm excited to introduce our first speaker today, Ms. Rouben, a respected authority in climate disclosures and risk management. Currently, Rouben heads the risk assurance services team at InCorp Singapore. Her career spans governance advisory, internal audit, and risk management roles across diverse sectors. And our second speaker today, Mr. Prakhar Gupta, as the lead for ESG advisory practices at InCorp India. Prakhar is crucial in guiding corporate clients on ESG practices. In today's session, Prakhar will share insights on climate changes, provide an overview of TCFD, which stands for Task Force on Climate-Related Financial Disclosures, and explain how InCorp services can support companies in these areas. Before we dive into the webinar, here's an overview agenda of what to expect from our two expert speakers. Number one, mandatory climate reporting requirements for listed and large non-listed companies. Number two, internal review on sustainability reporting process. Number three, InCorp TCFD consultancy services. And last but not least, question and answer session. So without further ado, let's welcome our first speaker, Rouben, to kickstart our webinar. Thank you.
Thank you, Benny, for the introduction. Let me first cover the overview and background for the mandatory climate reporting requirements for listed and large non-listed companies. Then I'll continue with the recommendations by the Sustainability Reporting Advisory Committee. So ACRA and SGX held a public consultation from July 6th to September 30th. So this was to gather feedback on the recommendations by the Sustainability Reporting Advisory Committee, also known as SRAC. So this is to improve and advance climate reporting in Singapore. Secondly, the SRAC's recommendations sought to reinforce Singapore's position as a global business hub and also align with the National Sustainable Development Objectives of the Singapore Green Plan. So bolder climate action and transparency in reporting can actually give key competitive advantages and present new business growth and opportunities for Singapore. These recommendations will also prepare companies to meet stakeholder expectations, including those of their customers and lenders accordingly. So as of now, only listed issuers in 5 prioritized industries are actually required to provide full TCFD-aligned CRD progressively from FY 2023. So which are these 5 prioritized industries? So these are financial, agriculture, food and forest products, and energy from 1st January 2023, materials and buildings and transportation from 1st January 2024. So the rest of the listed issuers are actually required to apply TCFD on a comply or explain basis. So let me now cover what exactly are the recommendations from the Sustainability Reporting Advisory Committee. So firstly, there's companies that are required to report. So which are these companies exactly? Secondly, in terms of reporting standard, what is supposed to be used? Thirdly, what is the external assurance requirements? Reporting and filing would be the fourth one. And finally, I'll be covering other legal requirements. So let's cover the first one, which is companies that are required to report. So 2 parts to this. The first one is mandatory climate reporting from FY 2025 for all listed issuers. So listed issuers, so these include those incorporated overseas, business trusts and real estate investment trusts. These should report their CRDs from FY 2025. So the reason for this is this will actually build on the momentum and progress in climate reporting. Secondly, mandatory climate reporting from FY 2027 for large non-listed companies limited by shares. So for the first one, large non-listed companies with annual revenue of at least 1 billion should make CRDs from FY 2027. Secondly, a review will actually be conducted in 2027 with the view to mandate climate reporting on large non-listed companies with a revenue of at least 100 million by around FY 2030. So what does this review actually consist of? This review will look at factors such as international developments, industry capacity, and the implementation experience of large non-listed companies. So there are certain exemptions that are put forth. So for example, for large non-listed companies, these will be exempted from mandatory reporting if their immediate, intermediate, or ultimate parent minimally prepares climate or sustainability reports in accordance with prescribed CRDs. Secondly, if their activities are included in the parent's report. The revenue threshold for large non-listed companies should be measured using their own company-level financials, and the revenue threshold for large non-listed company should be assessed based on the financials for the 2 financial years immediately preceding the current financial year. So for FY 2027, what is estimated is there are about 300 companies that are required to report after considering the relevant exemptions. By around FY 2030, around 2,200 companies would be up for implementation. Now let's talk about the reporting standards. So both listed issuers and large non-listed companies should report CRDs using the local prescribed standards that mirror the requirements in the ISSB standards. So to facilitate this implementation, ISSB has introduced a package of permanent, structural reliefs and temporary transition reliefs in the ISSB standards. So let's talk about the 3 a bit. First one is to apply at least the same duration of reliefs to all companies subject to mandatory reporting. So what does this mean? So if the ISSB grants a 1-year relief from providing comparative information upon adoption, this relief of at least the same duration will be provided accordingly. Secondly is to extend the duration of relief on Scope 3 GHG emissions for large non-listed companies subject to mandatory reporting. So what's the reason for this? As large non-listed companies are new to climate reporting, their requirements should be progressively imposed to give time for companies to implement the processes to measure their Scope 3 GHG emissions accordingly. Finally, to review the application of ISSB standards for disclosure of sustainability-related risks and opportunities beyond the CRD for all companies. So this will be reviewed and subject to mandatory reporting a few years later. Finally, allowing disclosures in compliance with other standards and frameworks. So one of the other standards that is being used is basically Global Reporting Initiative, known as GRI. So this is currently used by 98% of the top 50 listed issuers in Singapore. So what are the 2 conditions that need to be met? So the standards and frameworks are applied, need to be prominently disclosed in the report. The additional disclosure must not contradict or obscure the information required by the prescribed CRDs. So now let's talk about IFRS S1 and IFRS S2. So in June 2023, the ISSB issued its first 2 IFRS sustainability disclosure standards, which consist of general requirements for disclosure of sustainability-related financial information and also climate-related disclosures. So for the first one, IFRS S1, this requires entities to disclose information about its sustainability-related risks and opportunities that is useful to primary users for general-purpose financial reporting. So what does this consist of? This consists of 2 steps. The first one, which is to help identify sustainability-related risks and opportunities. Second is to determine the disclosures to provide in relation to this sustainability-related risks and opportunities relevant to the company and entity. And next is IFRS S2. So what exactly is this? It's a thematic standard that builds on the requirements of IFRS S1 and is focused on climate-related disclosures. So to basically achieve this objective, an entity is required to refer to and consider the applicability of industry-based disclosure topics, and also to look at 7 cross-industry matrix. So what are these cross-industry matrix? First one is greenhouse gas emissions, transition risks, physical risks, climate-related opportunities, capital deployment, and also internal carbon prices and remuneration. So next, let's talk about external assurance requirements. So for the first part, companies subjected to mandatory climate reporting should obtain external assurance on greenhouse gas Scope 1 and Scope 2 emissions from FY 2027. So this is for all listed issuers, and FY 2029 for large non-listed companies. So as of now, there's only about 2.8% of the listed issuers that have voluntarily obtained external assurance in 2020. So now let's talk about what kind of assurance is required. So there needs to be limited assurance over Scope 1 and Scope 2 GHG emissions. So let's cover the first one. This is 2 years after mandatory reporting kicks in. So what's the reason for this? This is to allow time for companies to be assurance ready. And climate auditors in Singapore will also need to develop the necessary assurance competencies and apply to be registered as climate auditors. Second one is the scope of limited assurance rather than reasonable assurance. So what is this exactly? This lower level of assurance, which is limited assurance, it actually involves fewer tests than in reasonable assurance engagement. So what this brings about is lower costs and compliance burden on the entities and companies. Finally, the limited assurance should be on Scope 1 and Scope 2 GHG emissions at the start. So the reason for this is GHG emissions enable investors to assess an organization's exposure to climate-related risks, and these are important information that is required. And this methodology to compute Scope 1 and Scope 2 GHG emissions is provided in the GHG protocol, and is also well established and involves fewer estimates. So for now, Scope 3 is actually excluded. So who can actually provide this assurance? So this assurance can be provided by ACRA registered audit firms and testing, inspection, certification firms, which are accredited by the Singapore Accreditation Council. So to align with global best practices, assurance needs to be conducted using two bases. First one is a Singapore standard equivalent to ISSA 5000, and the second one is an ISO standard. Next, which is the fourth part, let me cover the reporting and filing timelines. So CRDs should have the same reporting and filing timelines as financial statements. So what this does is facilitates timely communication to shareholders and other stakeholders. So the proposed timelines are indicated here. So there's some for listed companies in terms of circulation to shareholders, tabling at AGM, and also filing for public use. And there's also one that is listed for large non-listed companies. So CRDs should be filed in a digital structured format. So this facilitates the consumption of data and is consistent with the filing of financial statements and enhances the accessibility of climate-related information, and thereby actually encouraging the use of such information. So listed issuers can include the CRDs either in a separate report or as part of the annual report. And currently, about 60% of the listed issuers opt to issue standalone reports. So this is according to a 2021 study that was conducted. So if CRD is included in a separate report, both reports must be published at the same time. Okay, finally is the fifth portion, which is other legal requirements. So what are these proposed legal requirements for CRD? So this talks about keeping CRD records, circulating CRD and climate auditors report, tabling the CRD at AGM, and also appointing external climate auditors. So the parties responsible for these would be company and every officer, including every director. So the existing legal requirements related to financial reporting should be imposed on climate reporting, except for internal controls that should be encouraged. So the reason for this is that a company is responsible to devise and maintain a system of internal controls. But specifically for CRD, this is not mandated at this particular point. But to the extent that climate-related information is contained within the financial statements of companies, the existing requirements on internal controls will continue to apply to this information. So this requirement will be subsequently revisited when reasonable assurance is imposed on CRDs. Okay, so now let me cover the internal review on sustainability reporting process. So SGX actually requires issuers to subject the sustainability reporting process to internal review by the internal audit function for financial years commencing 1st January 2022. So this is something that is required by the SGX Practice Note 7.6. Okay, so this internal review needs to be conducted by the internal audit function. And what kind of standards do we need to use? We need to use the International Standards for the Professional Practice of Internal Auditing that is issued by the Institute of Internal Auditors. And this is, at this moment, not compulsory to be disclosed in the sustainability report. But for our clients, we actually encourage them to disclose it so that it shows that an internal review was actually performed on their sustainability reporting process. And finally, is it mandatory? Yes, it is, according to SGX Practice Note 7.6. So now I'll hand it over to my colleague, Prakhar, to share about InCorp's TCFD consultancy services.
Thanks, Ruby, for the insightful session on covering what all is required for the corporates to comply with the climate-related disclosure. But let me just take a couple of minutes to talk on the overall risk. So, I mean, climate risk is not new. It's real, and it is happening across all the parts of the world. And I think Singapore has also realized the same. In 2018, Singapore government published an advisory which says that what are the key climate-related impacts which are happening, which includes climate temperature rise, frequency of warm days and nights, rainfall, cluttering, and flash floods, increase of hurricanes and other related disasters, and rise of sea level definitely. And this was published way back in 2018. But I mean, this has become real since only in 5 years' time. Next slide, please. Yeah. So recently, on 13th May, Singapore saw the highest temperature day. I mean, it was crossed almost 40 years mark, and we saw a day which is having a very high temperature day, which is one of the risks which has sort of been getting rolled out next. As well, I mean, in terms of the flash flood, there was instances which are happening, and flash floods have also gone has risen in terms of the occurrences. And lastly, even on the sea level rise, there were advisories which have been issued, and which there are risks which have been identified that Singapore will also face a lot of sea level rise and impact which is arising from it. And because of this, next slide, please. Yeah, because of this, Singapore government has also issued has come up with a lot of action plans and action and key targets which are contributing to help Singapore survive for a longer period. So one of them is climate action goal. So already Singapore government has taken a net zero climate goal of 2050, and also there's a milestone which is there, which is by 2030 the government wants to hit 60 MT as a cap. So Singapore will hit by 2030 the maximum emission which will go by the government is, or by the country, is 60 MT. There is also an acceleration on low carbon transition. So a lot of actions have been taken. There's a push to transformation, especially on green energy. There's a push to adopt low carbon tech, green tech solutions within the country. There are also several international collaborations which Singapore government did, and also they are promoting not just the corporates but the individuals as well. And they've also come up with two big key enablers. One is carbon tax. Already there is a methodology which is out with respect to how the carbon tax will get implemented in a coming time by the Singapore government. And the next is mandatory TCFD reporting, which more or less we covered in our first section, that what is the transition roadmap of TCFD reporting. Already there is a mandate to all listed companies to start reporting either on comply and explain basis that what is the climate related risk and how they are adopting following the TCFD norms. So let me just explain you a bit about TCFD. So TCFD, or Task Force on Climate Related Financial Disclosure, is a task force which was created by Financial Stability Board, and the target given to this task force was to come up with a framework, come up with a structure in which corporates can adopt this framework to showcase the financial impacts of climate change which are happening. So it's a standard framework which they have been asked to prepare. In 2017, they come up with their first disclosure, or the first framework guidance. Although it was very new in 2017, the task then given to the TCFD was that how they can increase the adoption of the TCFD across the globe. And since 2017, when there was only 100 companies which have started reporting on TCFD, in 2023 there are close to 4,800 companies which have already started reporting on TCFD disclosure, and several countries have adopted this as a base framework in order to, help corporates to identify the risk and identify the impact of climate change, and also start disclosing the climate change related impacts and disclosures. So, breaking down into the core elements of TCFD, there are four basic things which TCFD focuses upon. First is how do you govern. Next is how do you identify, how do you implement, and how do you measure. So, the governance stage is mainly focuses on how the board and the overall structure, the policy structure, is supporting the towards the climate change. So, what is the climate change policy the company has? What is the board structure the company is following? What is the source of information company has with respect to how they receive the information on the impacts on climate change? Next is the implementation phase or the strategy phase. So, how do you translate the policies into the procedures? Is what the focus is all about. What are your actual potential climate change risks, and how are you mitigating that risk within the business? What strategy have you implemented? How your financial planning is getting impacted with these risks which are being arising. Just to add on, the risk might be transition risk or a physical risk which might be arising. So, and then the third part is identification. That how do you actually identify and going forward identify the potential risks? So, what are your potential growing physical risk? Let's say you might have a facility which is getting impacted by the rise of sea level. You might have a facility which is impacted by floods. You might have a raw material which is getting impacted by change of climate. So, how do you identify this risk which has been arising or potential risk which has been arising? So, what is your risk management methodology? And lastly, matrices and targets. How do you monitor and how do you report? So, basically, how do you monitor the climate, your impact on climate? Let's say scope 1, scope 2, which we just saw in the previous slides, or scope 3. That what are your emissions as of now, and what are you doing to reduce as emission? Is what TCFD has given the recommendation and the framework is all about. Next slide, please. Now, how do we enable this broadly? So, there are three base levels or three major levels on which the enablement of TCFD can happen, and that's where InCorp can help you in even helping you to enable the whole process. So, first is at the board governance level, which is setting up a board governance framework. I have just added an example of a company which is known as ILA, and the way they have presented it. So, it starts with what is the current structure of the board, which is supporting the whole identification and strategization of the climate change related risk. So whether you have a chief risk officer, whether he has given the task of also seeing the risk which is arising not just from the financial parameters but from a climate change parameter as well, which starts with the board governance framework. Next is adoption of a policy, which is what is your climate change policy? Now the name can vary. You might have a sustainability policy, you might have a ESG policy, or you might have a climate change policy. The idea is what is the internal rules and regulations, internal mechanisms to incorporate the arising risk of climate change into the day-to-day operations of the business. And last is working level committee. So if you see on the slide again, there is also a group risk management and a sustainability unit, which is again getting bifurcated into a sustainability council and enterprise risk management council. And that's how the whole implementation has happened. So not just at the board level, there's also an implementation committee which is being set up at the working group level, which manages the day-to-day implementations and the actions of the measures which the company is taking. So that's how the first layer of enablement, which is the governance layer. Next slide, please. Next is mainly with respect to the identification phase, which is identification and implementation phase. So it starts with conducting the materiality risk assessment, which is identifying your potential climate risk, which I said varies on physical and transition risk. So examples of physical risk, which I mentioned earlier, was how the rise of sea level is impacting your day-to-day operation. Is there any specific raw material which is getting shortage because of rise of temperature and is physically getting impacted to get that material? The transition risk is more with respect to change of regulations. The new climate tax which is coming up, Europe has already come up with the framework of the first climate tax and implementation framework of it. So how does that impact your day-to-day operation? What are the other regulations which are getting changed? The government is also pushing off a lot of adoption of renewable energy sources. So what will be the cost implication to the company? They do what they don't do to do the transition. So all sorts of risk is covered when we conduct the materiality risk assessment exercise. And again, example of Mercury report which they have done, they are showing the risk which is highlighted at the topmost layer, and they are describing the risk. The next is also identifying the horizon. So once you identify the risk, you have to also identify what is the impact horizon, whether the risk will impact you in short run, whether the risk will impact you in medium run, or the risk will impact you in the longer run. And again, when you define the medium, short term, long term, the idea is you will identify what do you mean by short term, whether it is 3 years, whether it is 5 years, whether it is 7 years. So identifying the horizon, and in each of the horizon, what is the impact that risk might create to you potentially or actually, is what you need to identify. And last is, once you have identified and adopted the strategies or the mitigation plan, you will test it with scenario analysis. So conducting a 1.5 degree change and a 2 degree change scenario analysis will help you to ensure and identify whether the mitigations which you have identified is actually working on ground. Next slide, please. Lastly, measurement, which is calculation phase. We support companies in calculating the scope 1, scope 2, scope 3 emission across the value chain. So right from your impact, your emission, which is happening from consumption of fuel, consumption of various categories of fuel, be it gasoline or diesel or coal and other similar fuel. The scope 2 mainly covers the emission which is happening from electricity sources. So what is your source of electricity, whether it is renewable versus non-renewable. And lastly, scope 3 emissions, which gets further bifurcated into 15 different categories, which cover the complete value chain and the emission happening in the whole value chain. Once you identify the complete set of emissions, the next is you should set up a target to achieve net zero. So that's what the most of the global companies are doing today, and there's a lot of push to their suppliers also to start adopting the net zero strategy. Again, an example of EXA, where they have first of all shown how the emission is calculated, and the scope 1, scope 2, scope 3 emission, also the intensity at different levels. What is the power consumption? What is the intensity of per rupee consumption? What is the intensity of each fleet size? And then taking the objectives, targets in place. So they have a performance target of 2025, and they have break it up into several measures that what they are doing and what they are taking. So that's how you will, at the end, present the whole report along with the measurements and the targets in place, and implement the complete TCFD in terms of right from the disclosures to the action. So that I think I've that's it from my end. I've covered. Over to you, Benny.
All right. Thank you so much, Rouben and Prakhar, for your valuable insights on TCFD and climate disclosures. Now we have about 10 minutes time for question and answer session to ask your questions. So please feel free to type in your questions in the Zoom chat Q&A feature for speakers to address them while we wait for more questions. There's one question posed. What does it mean by digital structured format? So Rouben, maybe you can help answer this question. Thank you.
Okay, thank you. So I think according to what has been proposed in terms of the recommendation by the SRAC, what it says is it needs to be in a digital structured format that is consistent with how the filing of the financial statements are being done. So something using XBRL technology. And I think when it's finally been confirmed, they'll probably advise further on what exactly needs to be done in terms of this.
All right. Thank you, Rouben. Okay, we have another question from the guest. How can me as a private company start on my ESG or TCFD journey? And what are the process of getting started? And how can InCorp help us? Maybe Prakhar can help answer that question.
Yeah, sure. So, in order to start the ESG journey, there are 3 major milestones, especially for adoption of TCFD. The first milestone is it starts with adoption of the policy. So we have to start identifying the structures and start identifying and writing the policy in terms of what are the key risks and what are the key impacts to the company, and then transition it with and add it with the second layer, which is conducting a materiality assessment or identifying the key materiality risk which is applicable to that sector and then applicable to that company, which is arising due to climate change. And lastly, the measures or the measurement stage, we can help companies to calculate their current impact of emission, current impact of climate change which is happening in the more financial and more magnitude manner. So helping them to calculate the scope 1, 2, 3 emission, and then working with them closely to come up with a strategy of decarbonization and the net zero roadmap is what we can help.
Okay, thanks, Prakhar. Another question, please explain which industry is it applicable and it is within those industry the listed and non-listed criteria apply. Ruby, can you help on this question?
Okay, sure. I think this is talking about probably the TCFD. So I think what we shared earlier, so maybe let me just go through that again. There are 5 prioritized industries. So for 1st January 2023, it's financial, agriculture, food and forest products, energy. So those are 3. And then 1st January 2024 is materials and buildings and transportation.
Okay, thank you. Next question, what is the main difference between ISSB reporting standards versus the current reporting requirements in our sustainability report for Singapore listed companies? Ruby, can you help answer this?
Okay, sure. So I think right now what is proposed by ISSB, and it's yet to be instituted here using our own SFRS, would be in terms of identifying sustainability related risks, and then also talking more about climate related disclosures according to TCFD. So I think right now when we use GRI, there's a different kind of disclosures associated with that. Prakhar, maybe you can update a bit more about GRI disclosures.
Sure. So right now, what SGX demands is mainly adoption of an international standard, and most of the companies have, because GRI is the most matured one. And globally, if you see, close to 70% of the companies are taking GRI as the base, and it is the most matured standard in terms of the industry, and that's where most of the Singapore companies are doing. Most of them have adopted GRI as the base structure, but IFRS or ISSB structures are building up as of now, and going forward in future we might see more adoption of IFRS coming down the lines and coming down the way. So I think it's a transition which is going on currently at the global level.
Okay, thank you, Prakhar and Ruby. Another ISSB question for the two of you. Is the ISSB mandatory reporting for listed companies only start from FY 2025? So which listed companies do nothing as of now other than what's mandatory now? And what's your recommendation?
Okay, so it is mandatory for basically the 5 industries that I shared earlier. So those that are not part of it can get on board to get started earlier. There's definitely advantages to get your comparative data and such to get started earlier instead of waiting until FY 2025. Prakhar, I'll let you add on.
Just to add on that thought, I think the applicability for SR or sustainability report is more wider, and climate related reportings are still, as you said, which follows the timeline. But then still the ESG report or SRs is mandatory for all listcos even before 2025. So I think that is something I just thought to add.
Okay, thank you. Another question will be, any views or comments towards the SGX ESG Jerome platform which was just launched, and should we onboard now or wait?
Okay, so I think for this, probably each company needs to see what advantage they have in terms of inputting their data in that or collecting the data. But I think looking at the proposed recommendations that are put forth, I think waiting at this moment is okay, because this is not something that is compulsory at this point in time to use the SGX genome.
Okay, thanks, Ruby. Another question for ESG. There are various major ESG standards such as GRI, and you say the popular one. Which are the considerations are there for me to decide which international standards to adopt?
Okay, maybe Prakhar, just start first. So I think what we have shared here is that the ISSB will issue, as it has issued IFRS 1 and IFRS 2. So that's something that needs to be used from FY 2025 onwards for listed companies. Apart from that, what else can you use is, like shared, there's GRI, which is popular, and then there's the UN SDG ones. So I'll let Prakhar take it from here.
In terms of the consideration also, which geography and for which stakeholder you are reporting also impacts when you adopt the reporting. For example, if your major customer base is in Western countries, mainly Europe and US, TCFD adoption becomes very important because these countries and customers are already keen on looking towards such disclosures. So apart from the mandatory requirements, even the stakeholders and considering their requirements also becomes important when you are taking this decision.
All right, thank you. Next question. What are the dates to comply with SGX requirements for climate change?
Okay, so I think I shared during the webinar. So FY 2025 would be for all listed companies. FY 2027 would be for large non-listed companies, 1 billion in revenue. And then this will be reviewed. And FY 2030, it would be possibly 100 million in terms of the large non-listed companies.
Okay. Next question. I am not a Singapore company nor a company registered in any of InCorp's 8 markets. Will InCorp be able to help me get on the ESG adoption? So maybe Prakhar, Rouben can help on this. Thanks.
We can. Already we are executing assignments in other parts of the country. We have done assignments in US, we have done assignments in other South Asian countries as well. So, I mean, in terms of the capabilities, we can definitely take up and help companies to do the adoption.
Rouben, you want to add on that?
Yeah, I think that part of it is so we can provide services as what Prakhar shared, including the framework creation, the reporting, and then also the calculations of the GHG emissions accordingly. So that's something that we can definitely do.
So it's not restricted to the 8 countries that InCorp group is in, right?
No, it's not.
It can be beyond and others. Okay, great.
Yes.
Next question. What is the difference between engaging an ESG consultant and using ESG metric portal solutions readily available in the market? For example, Lee Quanto.
Okay, so maybe I'll let Prakhar explain on what are the benefits of engaging an ESG consultant. Yeah.
So I mean, both of these solves different set of purposes, and the biggest challenge with companies adopting ESG as of now is lack of digitized data. The tools and the portals become very important and effective if you have digitized data in place. Even at certain places, the data is not even identified. So that's where consultant roles comes into play very importantly. In terms of when you are starting with doing the disclosures, we can help to identify what is required, how it is to be identified, and what to disclose in various markets. It's like you own a Ferrari, which is a metric portal, but then you don't know how to drive it, and that's where a consultant can help you in terms of driving that up. So that's the major difference with respect to the portals and individual performance.
Okay, thanks, Prakhar. I like the Ferrari example. Any more questions from the audience? Please ask now. Okay, while we wait, there's one question sent in by a registered guest. Maybe Rouben can help answer that. Which listed issuers are excluded from reporting climate-related disclosures, CRD, mirroring the requirements in the ISSB standards? Rouben, you're muted.
Yes. So to answer this, so issuers of listed debt securities are actually excluded as they are largely offered to wholesale investors, and these are typically traded over the counter. And then this information is actually expected to be disclosed in respect of the debt securities is limited as compared to the equity securities. So as such, issuers of listed debt securities may continue to adopt the international sustainability bond standards accordingly.
Okay, thank you. Okay, we have another question. How long roughly does it take for a company from start to implementation for ESG adoption? The time taken. So, Prakhar?
And so I mean, we usually divide this. I mean, it's not an exercise which it takes its own time. So there are some things which you can do in the first year and the second and the third year, but then it's a transition exercise. So usually, I mean, this starting engagement can happen from 4 to 6 months of time, and then it's a continuous engagement process wherein we try and improve the overall disclosures and the overall scope the company is right now disclosing and reporting. So, I mean, it's very difficult to stick a timeline in terms of how and what adoption phase might take.
But a typical example would usually take how long?
So if the company is starting, so usually what it takes is 6 to 8 months to publish the first report is what it takes in order to right before. I mean, they're assuming that they've not done anything in the past with respect to ESG. So it's close to 6 to 8 months time required where they can publish their first sustainability report.
Okay, thank you, Prakhar. Okay, another question by Mr. John Teo. By engaging an ESG consultant, would the consultant guide us to collate the data, like how the portal works, so that the data can be easily recorded, collected, and audited in years to come?
Okay, so maybe let me start off first. So I think what we do is we give data collection templates for the clients to actually complete. So that actually allows this data to be collected and reviewed accordingly. So Prakhar, I'll let you continue.
Yeah, so just to add on what Ruby said, I mean, the strategy which we take is we first divide also the data templates into more structured manner, which is by understanding the company's current department structure. So how the data is spread out within the company, what sort of department structure the company follows, and then creating the templates related to the specific department. So we'll put all the HR related queries together, all the emission or admin related queries together. And we also have ground level trainings conducted on the templates or the explanations conducted on the templates, which help clients to and the people who are working on the templates to better manage them in terms of what sort of unit of measurement is required, what data are we looking and where the data is. And they can also interact with us, their current issues, current problems in getting that data or sourcing that data, and we can jointly identify what could be the best alternative to capture the data if that is not already being captured.
Okay, thank you. Next question. Does TCFD requires to report only GHG emissions? How this is correlated to financials? Ruby, can you help on this?
I think I'll let Prakhar handle this.
It's a very interesting question, by the way. So how do you translate the emissions into financial is where the climate or the carbon tax comes into play. So a lot of countries, even Singapore, which has been announced, what is your product related impact? So it usually starts with identifying the carbon impact at the company level, but then eventually you have to roll it down to your service and the product in the going future. So once you start calculating, it has to go granular, and eventually the stage will arise wherein for each of the product, the way we do costings today, the way other taxations are being and it is put on a product, the future or the goal for a lot of governments across the world is how the carbon constituents of a product can be taxed. So that's where it will start impacting you on the financial parameters. Apart from this, there are also quick gains if you start migrating towards renewables, if you start migrating towards energy efficiency. Once you calculate, you will identify that you are spending more emission than your peers, and you'll start taking actions to improve and optimize your fuel consumption, optimize your energy consumption, which will give you financial benefit with respect to reductions on the of usage of the fuel and the energy. So these are the two short term and the long term gain or the impact if I have to translate into financial terms.
Okay, thank you, Prakhar. We have 2 more minutes for question and answer, so please fill in your questions before we end off. There's another 2 questions posted. Is CRD same with the disclosure in sustainability report? Is sustainability report still required if CRD has been done?
Okay, so the CRD basically has to be included in the sustainability report. So this is climate-related disclosures. So there are also other aspects that is included in the sustainability report accordingly in terms of social and governance, for example. Prakhar, anything to add to that?
I think you have covered it.
Okay.
Okay, thank you. A question from Ms. Sharon Lai. How do we start reporting Scope 1 and Scope 2 GHG emissions in Singapore for a financial institution?
So Prakhar, maybe I'll let you just handle this portion.
So to answer this question, I mean, it's a stage-wise method wherein we usually have companies to first identify what are their current emission points. So starting from fuel consumptions and energy consumptions happening at various points, identifying the source, and then computing or calculating how much consumption is there. And then there's a methodology to translate that into emission numbers is what we do. So it starts with the scoping phase, identification phase, and the calculation phase to do the calculation.
Okay, thank you, Prakhar. Okay, another last question, I think. Is it ESG reporting almost similar to ES reporting, like offshore companies, example BVI, which have some standard reporting format, info for classification of the reporting? If there are changes in the report, is it needed or reclassified?
Okay, so I think it depends on what framework is being used for the ES reporting. So I think as shared here, we are looking towards following ISSB, and then we can also disclose other relevant information through GRI or any other standards. And I think the last one is if there are any changes in the report, you can actually have voluntary revisions to it. So that is something that is allowed as per the proposed recommendations.
Okay, thank you, Ruby. So we have answered most of the questions. Any more questions? Last call for questions before we close off. Okay, looks like no more. If you have any further questions, please email us at info@incorp.asia and visit our website www.incorp.asia. So as we end off today's webinar, we really appreciate our audience engagement and thoughtful questions. We'll share the recording and the summary key points with all the registered participants in due course. Thank you so much for joining our webinar, and we look forward to talking with you soon. Thank you.